In the 2026 credit market, a 700 score has lost its status. This downward trend represents the quiet shift in bank standards. What used to be good is now being treated by lenders as strictly mediocre. Most people believe that simply avoiding late payments is enough to maintain a prime profile. However, the system has evolved into a rigid algorithm that requires more than just passive management. It requires active optimization. We've developed a 7-step blueprint designed to restructure a credit profile to meet the specific requirements of the 750+ threshold. Welcome to the Wealth Sprint US. Reaching 750 triggers a specific set of automated approvals in modern lending software. At this level, you're no longer just applying for loans. You're qualifying for the specific interest tiers used for prime mortgages and auto financing. Take a look at this standard banking interface. We've highlighted the statement closing date. Most users ignore this and focus only on the due date listed above it, which is the primary reason high scores remain out of reach. The credit bureaus take a snapshot of your account on that specific closing date. If a balance is visible during that window, it is reported as active debt for the entire month, even if you pay the full amount 24 hours later. To bypass this reporting cycle, we use the 15-3 payment rule. Look at the red closing date on this calendar. Our goal is to clear the balance before that snapshot occurs. First, automate a payment for half your monthly spending 15 days before the closing date. Second, set a final payment for the remaining balance 3 days before. As you can see, the reported balance metric drops to 0 just before the bureau receives the data. This dual payment sequence ensures the FICO algorithm never sees your actual peak spending. It forces the system to record a near zero utilization rate every single month. While lowering debt is essential, paying every single credit card down to a zero balance can actually stall your progress. We use the AZEO method, all zero except one. In this setup with 4 cards, the algorithm looks for a very specific distribution of debt across your accounts. You'll start by clearing the balances on 3 of these cards entirely. Notice how the meters lock into green, signaling to the system that these accounts have 0 revolving risk. On the final card, we leave exactly 1 to 3% utilization. This small amount of active data serves as proof that you are actively managing your available credit line. Once your balances are optimized, call your card issuer every 6 months to request a limit increase. You must explicitly tell the bank representative that you are only interested if it is a no hard pull increase. This gives you more room to spend without a credit inquiry lowering your score. By combining the AZEO balance strategy with a higher total limit, your utilization ratio drops to a point that satisfies the highest tier of the FICO algorithm. Beyond the math, we have to look at the data profile itself. Many files contain soft errors, minor inconsistencies like old addresses or name variations that flag you as a higher risk to automated lenders. Look at this credit dashboard mockup. You'll need to access your Experian or MyFICO portal and dispute any address you no longer live at. Cleaning these ghost identities provides a more stable profile for bank algorithms. You can also use data injection tools like Experian Boost. Link your rent, your utility bills, and streaming payments directly to your report to add positive payment history. The final step is the credit hitchhiker strategy, which involves using Authorized User status to bridge gaps in your credit history. Identify a family member with a card that has been open for at least 10 years with a perfect payment record. When you are added as an Authorized User, that entire decade of history is added to your file. Removing data errors while adding a decade of perfect history replaces a thin, unstable file with a profile that meets the specific stability requirements of modern lenders. By aligning payments with reporting dates, managing balances via AZEO, and scrubbing your data profile, you have addressed every major variable the algorithm tracks. This chart illustrates the difference in real-world costs. Over the life of a standard mortgage or auto loan, moving from a 700 to a 750+ score can result in tens of thousands of dollars in interest savings. Like this video if these Wealth Sprint US strategies helped you understand your score better, and share it with anyone you know who is shopping for a home or a car in this tight market. Subscribe to the Wealth Sprint US for our weekly wealth building blueprints. We'll see you next time as we continue to optimize your path to 750.